good, all my trader and investor homies? It's your boy Kevin. This is Touchdown Trades. In today's video, we're going to be breaking down why most retail traders and investors lose money in the stock market. And we're going to be looking at my personal stock market portfolio. And we're going to be talking about what I do different in order to not blow up my personal investing account and make money long-term investing in stocks. The recent price action over the last 6-7 months is not normal. The straight up to the moon price action that we have seen is not typical and cannot be sustained long term. The recent price action was filled with greed, hype, and FOMO. And it was just a matter of time until we saw a correction. And when that pullback, correction, or crash, whatever you want to call it, came, the greed left and panic set in. I have never seen as much panic in the market. Even when the Rona first came around and we saw the big Rona sell-off happen, there wasn't as much panic involved in that sell-off as we have seen in the most recent sell-off. Growth stocks have been absolutely crushed as retail investors panic out of their position and run for the hills. So let's break down some strategies that I've used to outperform the market over the last few years. If you're new to the channel, do me a favor and hit that subscribe button and turn on the notifications as we talk about the top stocks in the market every single day. If you want to get some free money, absolutely free money, click the link in the description for Webull. They're going to give you guys 2 free stocks if you use my link. Also, if you want to come trade with me and get my buy and sell orders in real time, click the first link in the description and check out my Patreon so you can get access to the private Discord chat. All right, let's break down the recent price action in the stock market, talk about some strategies that I employ to protect my account when crashes or pullbacks are happening, and we'll also break down some of the top stocks that I think are really good deals right now. Let's get it. Most retail traders and investors are going to lose money in the stock market, and we're going to talk about why in today's video. And the truth is 85% of big hedge funds underperform the overall stock market. So you'd be better off just buying the S&P 500 index than investing in a big hedge fund. We're going to talk about why retail traders and investors lose money, and we're going to talk about why the hedge funds underperform the big indexes. On the screen here, I have a screenshot of my personal investing account. We started this investing account with just $3,000 about 6 months ago, and we have grown it to over $31,000. We have seen massive returns, and this blip in the radar you see right here, this is the most recent pullback in the stock market. My portfolio is heavily invested in growth stocks. Every single position in this small account portfolio is a growth company. And we have seen growth stocks get absolutely crushed, 50, 60, 70% drops in a lot of these growth stocks over the last couple of weeks. But my portfolio is only down 10% on my open positions. And we're going to talk about how I have managed to increase my portfolio size in such a drastic way over the last few months, and how I protect myself from downside risks. And I didn't see that huge drawdown that a lot of investors saw in this most recent correction. The first thing that we need to understand is that this is a marathon. This is not a sprint. We're trying to beat the market long term. We're not just trying to beat the market for one day or 1 month or 1 year. We're trying to beat the market for years and years and years. This calculator here, this compound interest calculator, shows how powerful interest really is and how powerful beating the stock market over the long run can be. So let's say you started an account with $10,000, you add $500 a month over the course of 30 years. Let's say the overall market increases in value at an average rate of 10% annually. You start with $10,000, you add $500 a month, you're 20 years old. By the time you're 50, you will have $1.1 million in that account. That shows how compound interest works, and the growth just grows exponentially over time. You can see the chart, it just takes off and goes to the moon. But let's say you can beat the market. Let's say you can average 15% annually. Instead of 1.1 million, that extra 5% annually will generate you $3.2 million over that 30-year time frame. Let's say you absolutely crush the market, you get into some good growth companies, good growth stocks, low like we're seeing in a lot of these EV stocks right now, I think that's one of the best opportunities we will see in our lifetime. We'll talk more about that in a second. And let's say you average 25% annually over that 30 years. Your measly $10,000 startup account has turned into $27 million. That shows you how every 1% you beat the market, it becomes exponential. Your portfolio snowballs and it grows and goes to the moon. Now, that is important to realize because a lot of new traders and investors, they think this is a sprint. They're trying to chase the FOMO, they're buying into the hype, and they're going to get crushed. One of the biggest problems that new traders and investors are going to have is that they over leverage. They're using margin. If you're not familiar with what margin is, basically your broker will loan you money. Let's say you have $10,000 in your account. You have $10,000 in your brokerage account. So your broker, Webull, Robinhood, they're going to allow you to buy $20,000 in your portfolio, in your account, because they're loaning you an extra $10K. So let's say you buy $20,000 of one stock at $50 per share. Let's say that stock crashed. So you had $20,000 at $50 a share. Let's say it goes down to $25 per share. So you bought $20,000 at 50, it goes down to 25. You've lost half of your account. That $10,000 that you have is now gone. You've blown up your account. All your money is gone because you have to repay that $10K to the broker. So that is the power of margin. Now, I do occasionally use margin. If there's some great deals out there like there are right now, I will load up and use margin. But when the market was trading as high as it was recently, I was not using margin, and that saved me. If we go back and look at my account, we can see that my cash balance right now is $4,000. So I had a cash balance. I had money sitting on the sideline. I was not over leveraged. So when the market dropped, I had cash ready to add to these long-term positions, and that absolutely saved me. I think Lucid Motors and the pre-merger hype is a great example of why traders and investors lose money. Okay, up here, all the hype in the world was happening at $30, $40 per share here on the CCIV, and everybody's buying in, and I'm raising the red flag. I'm saying, even if this is the greatest company in the world, even if this stock goes to $200 per share, buying here at $40 is not worth the risk. The risk to reward ratio is not good. Sure, it went up to $60 per share, but if you're looking to buy long term, buy and hold long term, you didn't sell anything up here. Now look, we're trading at 20 bucks. If you bought in at margin up in this area, you've blown up your account and you're in big trouble. Hype and FOMO is the #1 downfall for retail investors and traders. I have a rule in my personal investing that I never buy a stock that's being hyped. I never buy into FOMO. And it's hard to fight that urge. You see a stock keep going up, 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 up. You want to buy, and it's hard to just sit on your hands and not press that buy button. Let's look at Tesla. I've missed out on a great opportunity here with Tesla. I wanted to buy back here, but I missed out because I didn't want to give into the hype. I wanted to buy back here. I missed out but because I didn't want to buy into the hype. But, you know, I have a very small position that I initiated way back here. But I missed out on a lot of great ads here on Tesla because I felt bad buying because my cost average was so low and I didn't want to raise that cost average. But over the long run, not buying into these hyped up stocks is going to save your portfolio. Yes, you're going to miss some opportunities. There are going to be some opportunities that you missed by sitting on your hands and not chasing. But over the long run, it will save you more often than it will hurt you. This website, robintrack.net, measures the amount of open positions in Robinhood. So we can see here on this chart that retail investors started pouring in here at the bottom when the Rona lows came in. And that was a great call. Retail investors nailed it and they bought in. But here's the problem. The retail investors that missed that buy right here at the Rona lows, they chased. Look where the most volume came in. It came in at the top. That is hype. That is FOMO. That is why retail investors and traders lose money. So what are you saying, Kevin? What are you saying? You shouldn't be buying stocks? What are you telling me right now? You should just buy index funds? The answer is no. I absolutely think that I can beat the market every single year. I think I can outperform the S&P 500. What I'm saying is we have to wait. We have to be like a tiger hiding in the grass. And when that antelope comes out, you jump out and you crush that antelope. And that's what I do with my personal investing. I see a stock I like that I want to invest in. I set a buy zone. For example, here on Tesla, I have a buy zone right here in front of this $500 support. $520 to $500 is my buy zone on Tesla. If we hit that buy zone, I will initiate and add to my current Tesla position. If we get one of these and it doesn't enter my buy zone, then I miss out and I don't buy. We have to have a plan. Set your buy zone. What's your buy zone and what's your profit target? Another big downfall for retail traders and investors is they never set a profit target. Why are you buying a stock? We're buying a stock to make money. Even if you want to hold for a decade or 20 years, you should have an idea of a profit target. Where are you going to take profit? Where are you going to sell? Maybe you sell 1/3 of your position for Tesla at $1,000 per share. Maybe you want to sell the next third at $1,500 and the next third at $2,000. Maybe it takes Tesla 5 years to get to that $2,000 price target. Maybe it takes a month. But you need to have a plan before you initiate and open a position. One of my main rules is I never use margin when the stock market is extended. And we can see that the stock market is still trading at all-time highs. So I'm not wanting to use margin yet, even though we've seen a massive pullback in the EV sector. And I think this is a massive buy opportunity. And I'm loading the boat on a bunch of these EV stocks. Look at the stock market. The S&P is still at 385. The SPY still at 385. We could very easily see the SPY down here in the 330s in the next couple of months. And if that happens, even though EV is really cheap right now, we could see the next leg down. And that's why I'm keeping some ammo dry on the sideline. I'm not going to initiate that margin just yet. I'm going to wait and see. And if we get that next pullback, the SPY breaks that level at 370 and heads towards 350, then I think the EV sector, even though it's really cheap already, I think we could see another leg down. Another great tool that I use is the 200 EMA on the daily chart. This is where big institutions and hedge funds like to buy this gray line here on the Tesla chart, because typically you're going to have a stock always pull back and test the 200 EMA. Doesn't matter how extended it gets above that 200 EMA, eventually you're going to come back and retest it. We can see here on Tesla it happens all the time. Test the 200 EMA and then it consolidates and then breaks out again. So we're coming into that 200 EMA here on Tesla, and I think a lot of buying is going to come in around that 200 moving average. All right, guys, that's going to wrap up the video. I just wanted to do this video real quick because I saw a bunch of people scared and kind of panicking out of their positions, and I never like to see that. This is when we should be buying. We should be buying the dip and selling the rip. Even if the dip is a crash, the stock market goes up long term. If we look at the S&P 500 chart real quick, let's look at a long-term time frame. Let's look at a monthly chart. Okay, so we can see there's a bunch of big crashes here on this monthly chart. We have the dot-com bubble right here. We have the housing market crash right here. We have the Rona over here. But every big crash we see in the stock market, it gets bought up. And that's how you beat the stock market long term, is by initiating your larger positions on these corrections. Look at these corrections. If you opened up long-term positions during these bigger corrections, you saw exponential returns, and that's why buying the dip works. Even if the dip lasts years, even if the dip lasts a couple years, if you open positions during the pullbacks, you beat the market, and that's how it works. I love all of you guys. I'll catch you on the next video. Until next time, peace.
It's not a game, it's a rich thing.